Welcome to the Mint Funds market update. I'm Alistair Dring, Assistant Portfolio Manager for the Mint Diversified Funds. Please take a minute to note the disclaimer regarding this recording. Right, the month of March, which was particularly tough for many portfolios, whether you were in fixed income or equities alike. It was broad-based pain in many parts of the market, bar a very, very small um, subset of sectors or subsector. So it can be summarized by the geopolitical tension and turmoil through shipping channels in the Middle East, which drove much of the story for the month. And you can clearly see that in the performance of the markets. Now, 6.7% down for global equities and 5.9% down for the NZX 50, which pulled the year-to-date figures negative across the board there, although the 1 year, 3 and 5 years still looking positive. Now, it was a very narrow shock, and this was felt broadly by almost all sectors of the market. And it was primarily, and as clearly seen in this sort of chart, energy and the energy price spike caused by a supply issue in oil and energy proliferated through to every other aspect and sector. Now, the differing filter through effects were quite interesting, with the likes of the input costs to materials and industrials being the main reason why we see those down at the bottom there, as those being most heavily impacted. A direct input to their production is energy, and therefore when that price goes up, it puts some significant pressure on their margins. The sentiment piece can be seen quite significantly through the consumer staples and the discretionary side of things, which is sort of a bit more second order. And then interestingly, the more downstream impact around how do central banks manage the rate environment on the back of an inflation shock can be seen through the sort of utilities and real estate underperformance, which are sort of duration assets, which are impacted by that rate environment. So interesting just to see how the different parts and different sectors of the market were impacted by quite a narrow origin, but the transmission has been quite broad across many sectors. So moving on to sort of how this impacts the global economy, and I thought we'd focus on some of the key trading partners for New Zealand, as that primarily affects us locally as well, which sort of is a good segue to the New Zealand economic section. What we looked at here was what particular nations New Zealand trades with primarily, and where they are in that sort of stagflation scenario, which is very difficult to manage from a monetary policy perspective, but also from a growth in outlooks in terms of trade and growth. So what we primarily looked at was where they were before this shock scenario. How was the economy positioned? What was the rate environment? Where was policy? And then, in addition to that, which was related to the energy shock, is how vulnerable or how dependent were they on energy or oil imports. And China, from a growth perspective, was the only nation that was printing positive, strong GDP numbers prior to the shock. There were a few green shoots in manufacturing or PMI or leading indicator areas from the likes of Japan, Singapore, and South Korea. Excuse that slide move. And then The other drivers being inflation. Many nations had just got a handle on inflation, or were on a journey to bringing it under control, but it was largely at or above central banks sort of target inflation figures. And as you can see as well, many of the nations that New Zealand does trade with are primary importers of energy or oil and have a significant vulnerability to that. And what we wanted to assess was the overall risk to those nations. China showing some manageable risk factors, mostly on the function of their strong GDP figures as well as their relative handle on inflation. And then also that, I suppose, gives their central bank a little bit more flexibility to implement policy if needed. And there are quite a few other nations that were significantly impacted by the shock, pushing them into that stagflationary territory. And again, that's a big concern for New Zealand because as those nations sort of struggle with growth and inflation and I suppose the relative move of central banks around monetary policy and the cost of sort of money and capital to invest, that then impacts New Zealand from an export perspective, as well as, what are the costs to import goods from those nations. So important to keep an eye on. The stagflation picture across New Zealand has those similar input factors that we looked at for those other nations. But again, we do also have the potential to import that through the significant trade that we do. One of the significant economic or macro reporting bits of information from the month was the 10-year yield curve spiking quite significantly towards the latter part of the month, moving close to 5%. And this was a function of three factors. Naturally, the Middle East energy shock that we've just been speaking about, but Fitch also downgraded New Zealand sovereign debt, citing that the GDP or debt to GDP figures were moving close to 56% on their forecast when looked at financial FY27. That widens the sovereign term premium, pushing yields up, and New Zealand government bonds fell. But as well as that, the front end of the curve repriced significantly higher based on the inflation shock, the proportionate then move that central banks, i.e. the RBNZ, would need to take in order to tame that inflation. Much of the market had priced in a potential for 2 additional hikes before the year is out. And that was, based primarily on the fact that there's elevated concerns, lower sentiment, lower growth figures, but also this inflation shock that we'll be potentially importing from the globe. Looking for some positives in a somewhat sort of gloomy scenario for the month, the New Zealand trades moved into a surplus after trading at a deficit for the last few months. This is somewhat nuanced in that much of the surplus has come from the fact that import demand is quite low. That's a function of consumer sentiment here in New Zealand, the general lack of growth, concerns around growth outlook. Businesses are spending less, consumers are buying less, importing less. But what it does mean is that as an exporting nation and higher commodity prices, it affects regional New Zealand positively. We hope that that is not a cyclical or seasonal reading, and that there is some long-term continuation with that. What that'll then do is it'll help the GDP figures. The lower import numbers will also mean that the amount of inflation that we do import will be slightly lower. So there is, some positives to that nuance. How did the two funds perform over the month? The income fund was down 2.7%. Again, on the fact that it's a large fixed income exposure, fixed income was not a place to hide the diversification benefits that one normally gets from fixed income when equities struggle was not present. Something that we've been aware of and is not a new concept, but something that we are looking to manage in the portfolio. But there were some positive equity names in Telix Pharmaceuticals that had some strong pipeline growth, and a few key sort of FDA changes around two particular products that were received very well by investors. Netflix was also a positive contributor of 4 bips on the back of the Warner Brothers Discovery acquisition. Had a 25% discount on the price based on that acquisition or M&A taking place. Because there was the announcement that that's not happening, that discount was removed and share price appreciated on the back of that. A negative contributor amongst quite a few was LVMH, primarily on that consumer sentiment piece we mentioned earlier. The Diversified Growth Fund was down 5.7%, large global equity exposure, as we pointed out, in all those sectoral performance detractors. There were quite a few, one being Unilever, again, the macro headwinds and just the conflict in the Middle East impacting the outlook for this company, contribute or detracting 9 basis points to the fund. Telix was a strong contributor of 12 basis points for the same reasons previously mentioned, but Infratil was also a contributor of 7 basis points, on the back of some strong AI-driven data center booms, CDC investments. Investors saw this as quite favorable, and the share price appreciated on the back of that. Again, thank you for your time. If you have any questions and need to get in touch with us, please feel free to do so. Happy to discuss any of the information here, or if you need any further details, you know where to find us. Thanks. Bye for now.